Hello, everyone, and welcome back to the anti-bubble report. We're going to continue with the central bank trap. And this is basically the situation that central banks are caught between the inflation they're creating and the bubbles they've created. And this is a very tricky one. Let's go into certain detail. We talked earlier about the framework. Here, basically a number of legs. The first one is this fallacy that you can actually print your way out of problems, which is not true. As I discussed at the beginning, monetary policy and fiscal policy without limits delay, transfer, transform, and enlarge the problems. But looking in detail at the monetary policy, we have this situation of zero nominal rates, quantitative easing, yield curve control, negative nominal interest rates. To me, a game changer and an aberration, which is taking place in multiple places. It broke the rules of the game. Deeply negative interest rates. Central banks not only buying government bonds but also credit and equities, is the case in Japan or in Switzerland or others. Helicopter money, MMT. And these excesses, which are, as I mentioned, driving this effort to print your way out of the problem. And I think all of this will lead eventually, as Voltaire said, paper money eventually converges to its intrinsic value, which is paper. So in that sense, this over-reliance, this overconfidence, this abuse of monetary policy, we can look at some history, and in this graph we look at how unconventional temporary measures tend to become conventional and permanent. And in blue you see the Fed funds, the short-term interest rates. In white you see the size of the central bank balance sheet, and we'll see what that means. But once upon a time, we had normal interest rates at 6.5%. We had the dot-com bubble. Things went down quite fast to about 1%, never quite got to zero. Things recovered very strongly, the revenge of the old economy. And you can see that, already rates went to about 5.5% before we had the 2008 global financial crisis. And that's when we, went to 0% interest rates. And we saw a meaningful expansion in the balance sheet. At the time, that was considered to be big and inflationary. We see how minute is in given today's type of action. The QE2, QE3, the perpetual response, QE3 named as Q infinity, and we see this dynamic which was exacerbated with, as I mentioned, the European crisis. But eventually, enough was enough. We thought, okay, let's try to normalize things. We started to taper for the first time, and we see that interest rates were only hiked, several years later. So the tapering started before. Expectation was, you even got to some degree of quantitative tightening, which was considered to be the path to recovery. But we only got to interest rates of about 2.5% before things imploded in Q4 2018, and we were at 1.5% pre-COVID, and obviously COVID has changed pretty much everything. Not only brought things back to zero, but we saw MMT and money printing at an unprecedented speed, scope, and size. So huge amount, very fast, and going to levels we haven't been before. So beyond the short-term rates on the balance sheet, I think what's interesting is to see what happens with the rest of the curve. And here you see how long-term interest rates, you see plotted here, the short-term rates, and then I think we have a mistake in the graph in the 10-year, but you see the dynamics with short-term rates, long-term rates. And the important message I want to show here is how long-term rates, the orange line, was sort of predicting where basically how high short-term rates could go. And this used to work well already in a period of massive debt expansion and long period of low rates. The expectation was that we would see interest rates going further up towards the end of 2018, but that didn't happen. We crashed the system before, and we're now in a situation where the question is to what extent, how long will we be at zero in dollars, which is Fed's kind of driving the overall global game, and also are these long-term rates a good predictable ceiling? And we know from previous experience that the trend is clear, and there's a risk that this has been overestimated. If you think about what the Federal Reserve is thinking with the dots, these are the votes, the expectation from the members. We see, yes, they expect things to hike. They're currently talking about 2.5% in the long term, but we also know that this is dramatically being reduced over time, and this is part of the dynamic we're seeing. So it's a world of low interest rates and constant abuse and reliance on this, and currently pointing towards a terminal rate of 2.5, which is substantially higher than what the market is predicting, and perhaps substantially higher than what the world might be able to live with if any hike might be possible. The second big dynamic is this fiscal policy without limits. First one was print your way out of a problem. This is borrow your way out of a problem. And we see how government spending and debt and tax cuts and overheating and bailouts and MMTs and checks to people and trade wars are all pushing to this prudent imprudence. You know, they go hand in hand. Obviously, government like Spain would not be able to borrow as much and as cheaply without the central bank printing money and giving it to them. So the left pocket lends to the right pocket. And so there's no central bank independence. This is all part of this plan. And is this as simple as this? Does this work this way? And clearly, you know, the third dynamic is let's inflate our way out of the problem. Let's inflate our way out of the debt. And here, for the longest time, you know, you looked at central banks respecting some sort of 2% inflation target, which is what I call the frog in the boiling water. It's a level that is we're all frogs in the monetary froth or broth, and you think about 2% as a number that is high enough that over 10 years you will dilute your purchase power by over 20% plus compounding. Over 20 plus years, it could steal literally 50% of your purchase power, but it's low enough that in the short term doesn't get people to jump. And that is important, and people have been used to that, and the CPIs might be, you know, not a fair reflection of volatility, but, you know, certainly central banks' independence has been compromised. This fallacy of deflation is the enemy, and that central banks have used to print even more. It faces also a lot of, you know, supportive arguments in that deflationary camp, which is there's a lot of deflationary forces, technology, demographics, overcapacity, malinvestment, whatever, even bubbles when they implode. But there's this one single force called money printing that offsets them all. And one of the things I'm going to elaborate much further today is inflation expectations. And this is really where things get complicated and where central banks, I think, start losing control. And today's print of 6.2 is still pointing in that direction. I think people, as frogs, might be willing to jump. So whether CPI is a fair reflection or not is obviously not. You don't need to be a genius to look at your inflation basket, whatever it is, housing, education, health, restaurants, supermarket, whatever. And this is obviously creating a problem for purchase power and inequality, which is the product that the central banks are creating. So ultimately, this leads to this situation that is very worrisome of high inflation, no growth. So inflation, you know, it's really about, it's not about the price of bread going up or your house going up. It's really about the value of the dollars with which you buy bread or your house going down. And I think we are in a new paradigm where, you know, the rules of the game have changed, and I think we will see high inflation and zero rates, because as we will see later, hiking interest rates and trying to normalize monetary policy will implode the bubbles. So let's look into inflation in more detail and the new paradigm, and also again to bring some history. Once upon a time, you had a world of high nominal interest rates. I picked the 10-year we could use any point in the curve, but you see that nominal rates were positive, call it 6%, and then inflation was indeed sub 2%. So you could actually park your money and earn interest, risk-free interest, above inflation, and that was considered to be normal. We remain with this sort of stable inflation. It's still being diluted, but we're being compensated through fixed income with a world of positive real yields. And then, deflation fears, GFC, and the crisis and printing led to a world of much lower nominal rates, whereas inflation after a short period of deflation picked up, and we've been living in that sort of world with real rates flirting with zero, and since COVID going deeply negative, something we'll see right now how it's accelerating in a meaningful way. So the question is, where are nominal rates going to go? Where are break-even is going to go? My bet is interest rates, nominal rates will stay low, inflation will stay higher, and therefore real rates will become further negative. We see that here. We see how inflation break-evens are breaking out, if I may. You see it for different maturities, for the 5-year, 10-year, 30-year, and this is really a much better assessment of inflation than CPI or any other construct. This is the break-even between people making the choice of, would you rather receive fixed dollars or something more floating, and that break-even between the two, implied by the price and the coupons, is accelerating, and it shows that people are not so happy to receive this fixed compensation, or they need much higher compensation, which is by inflation. So what's happened as a result of this is very important. We've transformed. I summarized the last decade as the transformation of risk-free interest into interest-free risk. We see how there's no such thing as risk-free interest, as we saw earlier. In Europe, it's even worse with negative nominal yields, but across the world, it's negative real yields. The second implication is with fixed income yields so low, particularly in Europe, Japan, and others where we have negative nominal yields, 60-40 balanced portfolios are no longer that effective, because what you get is the artificial interest rates have inflated everything, and the fixed income component has very limited room for defending. You've heard me before say that I compare the Bunds to Beckenbauer. So used to be a great defender, but not anymore. And perhaps moving to the more important side for me, beyond the changes to portfolio construction, which are huge, is one of the critical points is that if you have artificially low interest rates, you will have artificially high valuations. And this comes through a very simple principle that you're discounting cash flows at artificial rates. So this table shows you what it means when you discount at 5%, which is more of a historical average, or 0%. At 0%, a 2-year-old can do it. Discounting 0%, $100 in 100 years is worth 100 today. But if you take let's say 50 years of 5%, we see that there's over 90% difference. So we would be indifferent between at 5% interest rate between $9 today or 150 years. And this is kind of the problem in a world where inflation is going up, because ultimately the 100 euros that you will get back in 20, 30, 50 years are going to buy you nothing. And this is very clear from here. So the problem and the trap for central banks is that as these bubbles become too big to fail, I mean, think about what would happen if you increase interest rates and suddenly you destroy this present value and this implicit duration in equities. It would be a drama. And so we're now in this trap where central banks can't really hike interest rates, yet they are creating this huge inflation. We talked about the fallacy of temporary inflation, etc., in previous sections, and the problems associated with the bubbles and others such as China. So to me, the idea of monetary normalization is science fiction. And we're in a new paradigm that will see basically higher interest rates and low interest rates and high inflation. So what does this mean? And one of the consequences is, I talked about this before, the concept of equity duration, and how equities, that are discounting cash flows benefit from these artificial low interest rates, and how a very basic mistake has been to compare apples with pears. People make the argument that equities are cheap. They might be expensive in absolute terms, but they're cheap in relative if you compare them to fixed income. And the problem is they often compare S&P with a 10-year bond, where they should be using more of the 30-year bond in terms of equivalent duration. And when you do that, it's actually not cheap at all. So we believe equities have been high, both in absolute and relative terms. If you think about the wealth effect, I mean, this graph I borrowed it, it's pretty extraordinary. You see the wealth effect at the end of the day is the illusion of wealth. This is mark-to-market valuations that are created out of thin air by artificial things like artificial low interest rates, but they are central banks' best friend or best frenemy, as I say here. They use and abuse wealth effect through bubbles. You create this perception that you're rich that helps a lot on the way up, because you feel like you're spending more, etc. You might buy, if you're in crypto, you might buy a Lamborghini. I suggest that you pay for the Lamborghini with proceeds from selling crypto rather than a loan, because if that crypto goes to zero, then you're left with the Lamborghini and the loan. So this is a process that can actually bite you on the way down, and this wealth destruction is pretty huge. But ultimately, it incentivizes consumption, etc. We've seen how MMT has, obviously, when you put big checks in people's pockets, they spend them, but it also creates a lot of complacency and a lot of speculation. So this has contributed to this. The wealth effect is phenomenal, and I would argue that much of this is 100% artificial, and is creating, obviously, this asset inflation, inequality, and many other things that are more fragile than they look. In terms of another factor to consider is almost free money, with interest rates being so low, and there's a big incentive to buy back debt, to buy back equity. We've seen, according to this graph from Goldman Sachs, this is over $1 trillion of buybacks approved in 2021, which is a record. So this is, at the end of the day, hidden leverage, because companies are no longer relying on traditional financing through just regular loans. They are effectively levering up on equity finance. And what it means is, if this thing disappears, then you might be left with the need to borrow money at the wrong time, which is obviously a big issue. So we are seeing, I think the market this melt up has been brutal. By any stretch, we haven't been at these overbought levels for a while, but the market remains totally relentless. And so fighting the equity market is difficult, but I would argue that these bubbles are there. Yes, they're too big to fail, but also I think we've seen there are many reasons to believe that we could see a meaningful pullback. And if that happens, I think we might see mommy and daddy having to step back to prevent things from scaling out of control, as we discussed in the volatility section. With that, I hope this helps. I challenge some of the regular misconceptions in the market, and I will elaborate on some of these in other parts of the report. Thank you for your time and interest and support. Speak soon. Thank you.